Hello and welcome to this YouTube channel for ACCA FR exam prep. My name is Adam. In this video, I will be taking you through how to calculate goodwill at acquisition or consolidated goodwill. And I'm taking this question from the ACCA practice platform for FR, and it's question number 32, and it is a practice test 2. Practice test 2. So with your ACCA login details, you can have access to these questions. So you can also practice using this guide. So the requirement A, calculate the consolidated goodwill at the acquisition date of record, and it's 7 marks. So the requirement is the consolidated goodwill at the date of acquisition. So what I will do in my spreadsheet, and for the purpose of doing this, I want to just format the whole spreadsheet and make sure that my font is in 14 throughout. So just to ensure that you can see clearly when I'm typing. So I would have the first requirement. So I'll type in quickly here. So consolidated, very simple, consolidated goodwill on acquisition. So on acquisition of, and the name is Rockwood. So Rockwood, and that should be enough. You don't need to format this, or you don't need to change the font. So let's see the full heading of what we have quickly. So here is it. So it's in cell A. So we are seeing it clearly. Now, the next thing to do is to introduce our dollar currency sign. And I see on the left here, on the question area, the figures are in thousands of dollars. So I can put that in the cell B. So what I will do is to bring in the dollar value, raise it to 3 zeros. And again, you don't need to format this. Keep it simple when you are doing the calculation in the spreadsheet. Keep it simple. So I know that my goodwill calculation, I need consideration, I need NCI if any, I need net asset at acquisition. But what I will do is to quickly read through the question, scan through the question to identify these elements that I need for the goodwill calculation. So on 1st January 20XX, L'Oreal Co. acquired 60% of the equity share capital of Rockwood. So it means that the NCI is 40%. NCI 40%. In a share exchange in which L'Oreal Co. issued 3 new shares for every 5 shares it acquired in Rockwood. Now, the share issue has not yet been recorded in L'Oreal Co. And additionally, on 31st December 20XX, which is 12 months from the date of acquisition, L'Oreal Co. will pay the shareholders of Rockwood 1.62 per share acquired, and L'Oreal Co.'s cost of capital is 8%. So this is a deferred consideration. So we need to discount it to the date of acquisition, which is 12 months. And at the date of acquisition, the shares in L'Oreal Co. and Rockwood had a market value of 7 and 2 respectively. So now let's put these information in the calculation. But what it means is that we need a share capital of Rockwood. So what it means is we go down, and this is the P&L information. So we have revenue, cost of sale, and so on. And what I need here, the equity as at 1st October X5. And if you look at the year end, the year ends 30th September X6. So we need the share capital from that date, and often the share capital will be the same. So for Rockwood, it's 15 million. So what we'll need to do here is to bring our consideration. So I'll have consideration. So I'll bring consideration here, and I'll bring a column and a consideration I have share exchange. So I'll type share exchange quickly, and the formula which will be in the cell B, I'll put equal to. So I'm building the formula, and you need to do that for the max. So the share capital I can see on the left is 15. So it's 15 million. So it's 15,000 times the percentage acquired, and that is 60%. So 0.6 times the share exchange fraction, which is 3 divided by 5. Then times the market value, and the market value of Laurel Co shares on that date is 7. So I put in 7, and that should give us the value of the shares. So we enter. So if you put the cursor back here, you see in the formula tax bar here, you see the formula, how you get that figure of 37,800. Now the next thing to do is to look at the deferred. So I'll bring the deferred consideration. So the deferred consideration. So I'll put here how we calculate that. And again, it is the 15 million, which is the number of shares, times the percentage, which is 60%, times the price they will pay, which is 1.62, times the discount factor. And the discount factor, because it's 12 months away, it is 1 divided by 1.08 raised to power 1. And effectively raised to power 1 is the same. So if you want, just for the sake of it, you can say raised to power 1. That is to give you 1 year. If it is 2 years, it's raised to power 2, and so on. So we can enter to have the answer, and that is 13,500. Now the next thing to have, I'll leave a line in between, is to look for my non-controlling interest, NCI. So I'll type here NCI at acquisition. So I'll do that here, and then go look for how the NCI is calculated, and you often find that in the additional information. So briefly, let's summarize the additional information. At the date of acquisition, Laurel conducted a fair value exercise on Raku's net assets, which were equal to their carrying amount, with the following exception. So an item of plant had a fair value of 4 million above the carrying amount, and at the date of acquisition, it had a remaining life of 2 years. So this is for fair value depreciation. Inventory of 800,000 had a fair value of 1 million. So the fair value adjustment here will be 200. And the inventory, all the inventory have been sold at date. Now, point number 2, Laurel Co's policy is to value the non-controlling interest at the fair value at the date of acquisition. And for this purpose, Raku's share price at 1st January exits can be deemed to be representative of the fair value of the shares held by the non-controlling interest. And that is what we need. So here, the price we were given as 2 is what we'll use. So I'll type in here again, equal to, and is the number of shares 15 times their percentage. This time it is 40%, so 0.4, and times the share price of Raku, which is 2, and that will give me the NCI value, and that is the value you have there. So what I'll do is to bring the total. So I'll bring total here, total of these. Let me just bring it there, and this is equal to this plus this plus this. You need to build that formula, and that is 63,300. You need to build that formula. Now the next thing I will do is to bring my net asset. So here I'll say net assets at acquisition, and remember, it is always the fair value. We need a fair value. We need a fair value. Why do I need? I need a share capital, and the share capital was given here. So this information. So I'll type the share capital. So share capital here, and now it's 15 million. So I'll type that 15 million, and then I'll bring the retained earnings. So I'll say retained earnings. So retained earnings, and please watch how I'm going to account for this. So retained earnings at acquisition. I'll bring a column, and what I'll do is to look at the retained earnings at, which is the start of the year, that is 1st October 20x5. So retained earnings at 1st October, so October 20x5. You keep it simple, and what I'll do is to say the figure is 25. I'll type in the 25,000, which is 25 million. Then I need the part of the profit, which is the pre-acquisition profit, as at 1st January. So if you look at from the start of the year, which is 1st October x5 to 1st January x6, so you count the number of months: October, December, October, November, December. That is 3 months. So I'll say pre-acquisition profit, and that should be the profit for the year, which is given. I'll just go up here. The profit for the year in the information here for Rockwood is 10,400. So I'll type 10,400 times the number of months, which will be 3 divided by 12, and I'll have the answer. Very simple. Now the next thing I'll do is to bring my fair value. Let me just raise this up a bit. Is to bring my fair value adjustment. Fair value adjustment. So I'll just type it there, fair value adjustment. And what I need is the plant, which we were given in note 1. The plant here, to refer to it, it had a current amount of 4 million above. So I'll put here 4,000. And then I'll look at inventory. And please take note of this. Inventory, it should be equal to, it had a fair value of 1 million, carrying amount of 800. So the adjustment should be 1,000 minus 800, and that should give you 200. So having done this, what I will do is to find the sum, the total of these net asset and acquisition, and I'm going to perform what we call the manual sum. And please take note, very important in the spreadsheet, because you don't have auto sum functionality in the exam. There is no auto sum. So what I'll do is to do a manual sum. So I'll say equal to, but keep it simple. I'll say equal to, then I'll type sum. So sum. Then I'll open bracket. Then I say is the sum of these items here. So I'll drag it down. After I've opened the bracket, I'll take the share capital and drag it down. And now I'll say enter. So look at it. It has given me the total of the net asset at acquisition. And up here, you see the formula. And the examiners want, or the markers, they want to see this formula. So you are not to calculate it on your calculator and type the answer. So finally, we can bring our goodwill. So our goodwill would be equal to, what do we need? We need a total consideration and NCI. So I'll say equal to. So I'm going to make reference to the earlier calculation we performed for the total. So I'll say equal to this one minus the net asset. And that should give me a goodwill. And I have my goodwill as 16,500, which is 16.5 million. Please remember, you have to calculate the consolidated goodwill at acquisition. Another requirement can be that calculate the consolidated goodwill in the consolidated account. Now, if you are asked for the consolidated goodwill at the end of the year, it means that if there is any impairment, and let's go down to look for impairment information. Is the last information here, note 6. It says that there were no impairment losses within the group. So if there were impairment, you would have come here to say impairment lesson. and then you have consolidated goodwill. So for this question, have a look at the calculation again. I'm just going to wide the screen so you can see it clearly. So this is our goodwill calculation for Rockwood, the acquisition. Very simple. Keep it simple. Keep it simple. So just to bold these ones for you to have a look at again. Just to bold it for you to have a look at. So I'll just bold everything here. I'm taking it down to bold it. So you can just I want it the font to be a bit bigger, so you can have a good look at it. Okay, it's not responding, but I hope you have a good look at this, right from the calculation of the consideration and then the net asset. So I hope this helps you in your preparation for the exam. Please subscribe to this channel to receive updates on new videos.